welcome to today's video. In this session, we're going to dive deep into the topic of international financial management. In today's globalized world, companies that operate across multiple countries need to navigate complex financial environment. Managing finance effectively on a global scale is crucial for companies to stay competitive and profitable. But what exactly in international financial management? And why is it also important for companies that are operating across different countries? Let's break it down together. What is international financial management? International financial management refers to the process of managing financial research, investment, and strategies of a company operating in more than one country. This branch of finance is different from traditional financial management because it involves multiple currencies, legal systems, tax policies, and financial markets. When companies expand internationally, they encounter new challenges. For example, they might need to deal with exchange rate fluctuation, managing funds across borders, and understanding the varying economic and financial regulation of each country. The key to success in international financial management is understanding how to minimize risks while maximize financial performance across global markets. Unlike domestic financial management, international financial management considers how to handle investment in countries with different financial systems and tax laws, while also factoring in political and economic risks that could affect the business. Key objective of international financial management. The primary goal of international financial management is to ensure that a company maximizes its profitability while managing the financial risks that come with operating in multiple countries. Here are the key objectives. 1. Risk management. Managing financial risks is at the core of international financial management. This includes understanding currency risks, interest rate risks, and political risks. By identifying these risks, companies can take proactive measures to reduce their exposure, ensuring financial stability even when the environment changes unexpectedly. 2. Capital budgeting and investment decision. International financial managers must make decisions regarding which market to invest in and how to allocate capital across different countries. This involves conducting thorough analysis of the risks and return of potential investment in foreign countries and ensuring that capital is used efficiently to generate growth. 3. Financial planning and control. Creating a comprehensive financial plan is essential to managing cash flow, funding, and investment across borders. Companies need to forecast future financial needs and ensure they have the appropriate mechanism to control their global financial operation. And last, profit maximization. The ultimate goal of international financial management is to increase profit. This includes optimize the company operation, managing costs, increasing revenue, and improving operational efficiency across different markets. Challenge in international financial management. Managing finance in an international context comes with a set of challenges that financial managers must carefully navigate. Let's discuss some of the main challenges. 1. Currency risks and exchange rate volatility. Currency risk is one of the biggest challenges faced by international business. Since most companies deal in multiple currencies, fluctuation in exchange rate can significantly affect their profitability. A sudden change in the value of a foreign currency can either increase or decrease the company costs, revenue, and profit. For example, if a US company sells goods to Europe country and the euro depreciate against the US dollar, the company revenue in euro will be worth less when converted back to dollars. This can result in a reduction in profit even if the sales volume remains the same. 2. Political and economic risks. Political instability and economic crisis in country where a company operates can have a major impact on its financial results. Change in government policy, sudden taxes, or economic sanctions can lead to financial loss or disrupt operation. For instance, if a company operates in a country that undergoes a political revolution or face economic collapse, they might face a disruption in the supply chains, change in customer demand, or even asset devaluation. Navigating these risks requires careful political analysis and risk mitigation strategies. And last, difference in taxation and regulatory policy. Every country has in own tax laws, financial regulation, and legal system. This creates a complex environment for international business to navigate. Companies must understand how different tax structure in various countries will affect their bottom line. For example, a company that expands to a high-tax country might find that its profits are significantly reduced after tax, making the investment less attractive. Additionally, regulatory change in different countries can also affect how business operate. Companies need to ensure compliance with local laws and regulations to avoid a penalty or legal issue that could harm their operation. Key strategies in international financial management. To tackle this challenge, companies must develop effective strategies in international financial management. Let's go through some of the key strategies that business use to manage their finance on a global scale. 1. Hedging to manage currency risks. One of the most common strategies used to mitigate currency risks is hedging. Hedging allows companies to protect themselves against unfavorable exchange rate movement. For example, companies can use forward contract or option to lock in exchange rates for future transactions. This provides stability and helps them avoid the risk of currency fluctuation. Another tool that companies use is currency swaps, where companies exchange one currency for another for a set period, allowing them to manage cash flow and minimize risks related to exchange rate movement. 2. Diversification of market and investment. This diversification is a strategy used to spread risks across various geographic regions and industry. By entering multiple markets, companies reduce their dependence on a single region. If one market faces economic downturn or political instability, the company still has operations in other areas that can sustain its overall performance. In addition to geographical diversification, companies can also diversify their product lines and investment portfolio to further reduce risks. This approach ensures that a downturn in one sector does not severely impact the company bottom line. And last, international financial option. Companies operating international need to consider different methods of financial operation. One option is to raise capital through international capital markets, such as using bond or stock on foreign exchange. This allows companies to access a larger pool and investor and secure funding at favorable terms. Another financing option is international bank loans, which may provide lower interest rate than domestic financing. Companies can also use internet financing and reinvesting profit from their international operation back into the business to fund growth. Example of successful global companies. Let's take a look at some global giants like Apple and Coca-Cola, which are prime example of companies that operate on a global scale. These companies use international financial management strategies to navigate the complexity of global market. For example, Apple faced currency risks when selling products in various countries, so it used hedging strategies to protect its profit from currency fluctuation. Similarly, Coca-Cola operates in over 200 countries and has to manage different tax systems, political environment, and cultural consideration in each region. By applying sound international financial management practice, both companies have been able to achieve global success. In conclusion, international financial management is critical for companies that wish to operate globally. The financial risks associated with exchange rates, political instability, and regulatory indifference require careful planning and management. By using strategies like hedging, diversification, and securing international financing, companies can reduce risks and increase their profitability on the global stage. I hope this video has helped you understand the importance of international financial management. If you found the content useful, don't forget to like, subscribe, and turn on notification for more inspired video. Thank you for watching and see you in the next video. Bye bye.